Now we're going to go into our panel. It was very nice for Dan Fuss to warm up the audience for us. Thank you, Dan. We appreciate it. So this is the third year of our directors panel. And for those of you who don't know me, I'm Andrew Altfest. We thought that the first time that we would do this panel and talk to you all about financial planning strategies that we think are timely and relevant for you, that talking about taxes and insurance and investments, that would be a one-time thing. You wouldn't ask us to come back after that. Last year, we upped the ante, and we went into estate planning and investment strategies. And again, we got great feedback. So we're back. We know what you like. We know what you want to hear more of. And we're going to talk about things that we're thinking about and doing that will help you. We have with us tonight our long star-studded panel, which consists of Paul Palazzo, Ekta Patel, and Mike Prendergast. Everyone on the panel has been with Altfest for at least 14 years. I'm actually the junior guy in the panel with 14 years of experience at Altfest. The three wealth management teams report into these three people. Aside from client work, Paul is also the head of our financial planning committee. Ekta Patel works closely with him and is also on our portfolio action group. Mike is a subject matter expert on a number of different financial planning strategies and is also on our investment committee. And I'm on our portfolio action group and work closely with Paul and Ekta driving a number of different financial planning strategies. On that note, I'm going to turn it over to Paul and Ekta.
Thank you, Andrew. So everybody got food, right? Okay, good. You know, in France, they have this thing called the cheese course. And the cheese course, as Ekta well knows, follows the main course and precedes the dessert. And cheese being what it is in France, it's a vitally important part of the meal, and it's also a time of provocative and stimulating conversation. So this, ladies and gentlemen, we are the cheese course this evening. And to follow that line of thought, if that's possible, imagine for a moment your personal finances as a meal. Now, most people, many if not most people, consider investments sort of the star of the show. The succulent salmon or steak that you sink your mouth into. But just as your personal diet and your personal fitness doesn't thrive on protein alone, so your financial health doesn't thrive simply on smart and sound investments. The other things on that plate, the retirement planning, insurance, estate, which Mike will be talking to you about in a few moments, those also play a vitally important role, not only in themselves, but in the way they connect with one another. Taken together with the proper structure and interactions, they are building blocks to sound financial health. And that's kind of the theme of this talk. I'll tell you that this concept, the concept of total financial planning, is something that resonates and is top of mind with everyone at our firm, beginning with the principals. And it's something that we pay a lot of attention to, and that's what we're going to be talking about this evening. Now, sometimes this planning stuff can get a little complicated. Lou mentioned before the quantitative analysis, and we do our share of that. But the great thing about it is we've got some really, really smart people here. We've got CFPs and CFAs and MBAs and every alphabet under the sun. And as a matter of fact, we had one client who was sitting with one of our teams, and after 6 or 7 terrific suggestions, she just looked at the members of her team and kind of smiled and said, "You guys are the best geeks I've ever met." And we take that as a compliment. So it can be complicated, but not always. Sometimes it's just simple or practical problem solving. And I'll give you an example of that. We had met with a client not long ago, and part of the way through the conversation, this client mentioned that one of his concerns was that one of his children had graduated from dental school with a mountain of high interest debt. And he wanted to find a way to help his son, but he didn't want to pay off the debt, but he wanted to find a way to help him. So what we talked to him about, we said, why don't you think about, maybe you should think about taking over the loan yourself. And in doing that, you could cut the interest rate, give him a reasonable rate that would be more affordable, help him out a little bit, and at the same time, get a yield on your investment that's, at least competitive with what you're getting in the markets. So now, okay, this wasn't probably the most profound bit of advice we've ever given out, but it was helpful, it was simple, it was practical, and it was tremendously appreciated by the client. It was just kind of everyday wisdom. And so with that, I'm going to turn it over to Ekta, who will kind of tell you what the moral of that story is.
I think the moral here is that if you haven't talked to Paul recently, you should all call him because he has a lot of thoughtful advice for all of us here. But in all seriousness, I think he's making an important point that we should have regular conversations with you, and you should come in for an ongoing regular meetings with us. And if you haven't talked to us in a while, and when you come in next, you might even notice a little bit of a change in how we want to do things. So, for instance, we will continue to review your portfolios when you come and see us. We'll continue to talk to you about the discussions we've had with our portfolio managers, such as Dan Fuss, and share our ideas on the market. But at the same time, you'll also find us going over a list of financial planning items that we might have prepared for you. And going forward, what we are really planning here is that we want to explore the various aspects of the financial planning that touches you. We want to make sure that you're not taking any unnecessary risk on your personal lives, and you are also not missing out on any opportunities that comes along your way, like the simple exam that Paul mentioned about taking the loans over. Now, in order to do that on our end, prior to having a meeting with you, what we've been doing is we're taking now historical inventory of every financial matters that we've discussed with you in the past. And I'll tell you why that is important. Number of things. One, well, it tells us what we know about you. It tells us what we know about, let's say, your insurance. We know about your estate planning, your income, your withdrawal needs, etc. It also tells us what we need updates on or what we need review on. So for instance, since we last met, maybe you've gotten a raise or had a child, and now we should discuss, your life insurance needs with you. And finally, the third point I'm going to make is very important, what we don't know about you. And there are times when we look through the list and we wonder like, oh, gee, I've not had a long-term care conversation with this client. But this is the reason why we want to cover all our base and add structure, in a sense, to our meetings. We think that this is extremely important because it adds some context and also dictates the timing of our future services with you. So, for example, we might find out when certain events might happen with you, such as, it's time for you to take Social Security or apply for Medicare. So we'll work with you and be proactive about being in touch with you so that these things are placed when the time comes. Our goal really is simple here. We want to provide you the services that are based on your needs, but at the same time, we want to make sure that the timing of it is also correct. Now, we can only make this happen if we have your cooperation. And with financial planning, without information and data, we really have nothing, and really that's where you come in. So there are certain things we can do on our own. There are certain things like checking IRA, beneficiary designation. Those are things that we can do on our own because we have access to that information. But at the same time, for a lot of other things, we want to rely on you to get us the information. So if you receive a very friendly request from us seeking more data from you, please be considerate of it and send us the information we've asked for. But let me give you an example how we can use this information. So just recently, in advance of a client meeting, we asked the client to send a bunch of documents, and one of them being trust and estate documents. Now, this client had recently met with the estate attorney and put the entire estate plan in place, and he was very happy that at least there was something that was in place and he was in control of. And he really wasn't understanding why we were asking for it, but he obliged at our request and sent us the documents anyway. And while discussing this estate planning over a meeting with him, one of our key advisors, team leaders, actually Dan Duca, he noticed that certain language regarding the distribution of assets was rather unclear or confusing. So we asked the client to go meet with the attorney and get it resolved. Because if this issue was overlooked, it could have potentially created problems at the time of the distribution of the estate. And the point I'm trying to make here is that we were only able to help the client because they sent us the information. And this is why we want to collect the data, and this is how you can help us help in this matter. So, and we understand that you're busy, and really we want to be respectful of your time, your valuable time here. So even if you can get to one or two things when we ask for, that's fine. We'll take one step at a time. If you don't know how to get the information, then just please give us a call and we might be able to guide you in the right direction. Our goal and intention really is to make this process simpler for you. And in that, we also want to do this in a collaborative manner.
Thank you, Ekta. Before we turn it over to Mike to tell you a little bit about estate planning, I just want to take 1 or 2 moments and tell you a little bit about our financial planning committee. We have like 10 people here at the firm who contribute to the financial planning committee in a number of ways. That might be research, where somebody becomes an expert in a particular area and shares that knowledge with the rest of us so that we can help you. It may be driving or contributing to a project. One project we're working on right now is we're looking at our assumptions for investment returns going forward in the context of the retirement plans that we do for clients. And so that's something that doing that work will enable us to do a better job with you, and it's important. One of the main accomplishments, probably the biggest accomplishment we've had as a committee since we last met here a year ago, is a selection of a new financial planning software. A group of us spent months investigating and researching and testing different programs. And the result of that work is that, as we speak here, we're signing a contract with eMoney, a leader in the industry. Now, what that means for you is a couple of things. We feel we'll be able to do a wider breadth and more in-depth reports and illustrations of where you stand financially and where you are going financially and how we can help you get there in a number of planning areas. It will also give you the opportunity, if you choose, to become even more actively involved in your own planning. For example, if you're interested in tracking your expenses, which a number of our clients are, you'll be able to link your credit card and bank statements and other accounts through the portal in this software, and that'll give you an easy, handy way to do that. So you'll be hearing more about these things in the coming weeks, more specifics from us over the coming weeks and months. But I think, just to close, I think the theme of all this simply, in my view, is collaboration. It's a collaborative approach, and we want to be able to walk with you through the financial planning process and have you understand that our goal is the same simply and clearly as your goal is, which is your financial well-being.
Great. And hello, everyone. Thank you for coming tonight. It's really great to see so many friends in the audience. I'm here tonight to talk to you about one of the financial planning items that we'd like to discuss with you when you come in to meet with us. Now, Paul mentioned that for many, investments are the steak and salmon topic. I beg to differ. No. For those of you who attended last year's event, I'm sure you fondly remember the steak topic of the evening that I had been asked to present beneficiary designation forms. This year, I'm happy to announce that my topic is even steakier, if that's possible, a real filet mignon. It's durable powers of attorney. So a durable power of attorney, or DPOA for short, is, as some of you know, some of you may not know as much, is a legal document that designates a highly trusted friend or family member or professional advisor to act as your agent regarding various financial and legal matters. Highly trusted are the key words here, because you're giving the durable power of attorney designee very significant powers. You want to be very confident that they would always be using these powers in your best interests. It's called a durable power of attorney because it stays in force even if the person who created it, legally called the principal, becomes incapacitated. If incapacitation does happen and the principal is not able to manage their financial affairs, the person you named as the DPOA agent on the document will legally be able to make decisions on your behalf so that your financial affairs, including giving guidance to your wealth management firm Altfest, will continue running smoothly. If a person becomes incapacitated and has not created a durable power of attorney, the person's family will need to go to court to ask for a guardian to be appointed to manage the person's financial matters. Not only could this turn out to be a very time-consuming and expensive process, but it could also strain relations within the family, as different family members may have different opinions as to who would be able to best serve in the role of guardian. Equally important, the guardian who was appointed by the court may not be the person that you, the principal, would have chosen. The goal is to be able to decide in advance who would be the best person to manage your financial affairs besides yourself, to save your family any unnecessary time, expense, or frustration in the event that someone else would need to step in. An example of how a durable power of attorney could really help, or helped actually one of our clients, could be useful to mention now. One of our clients suffered a stroke when he was in his mid-50s. Because he had though, the foresight to plan ahead, he had already prepared a durable power of attorney. The DPOA allowed his chosen agent the ability to seamlessly start overseeing his financial matters, including giving him instructions about the portfolio and requesting payments of his various living and healthcare expenses. Later on, when it made sense to execute some legal and financial planning so that the man would be able to protect some of his assets for his heirs while still being able to access Medicaid, the durable power of attorney holder, together with Altfest, was able to successfully work with an elder care attorney to make it happen. Some questions about durable powers of attorney and a key fact. A question, does creating a durable power of attorney mean that the grantor of the DPOA no longer has control of his or her finances? Absolutely not. Creating a DPOA does not reduce your authority over your finances. It really just creates another person who can legally make decisions regarding your financial matters if needed. Question, I created one of these durable powers of attorneys a long time ago, so I'm covered and everything's great, right? Well, it really depends on when it was done. If your durable power of attorney is old enough to vote and serve in the military, it's likely not giving you the full protection that you want. In New York State, the durable power of attorney laws were changed significantly in September of 2010. So if yours was executed before then, it definitely makes sense and should be reviewed by your estate or elder care attorney. Can a DPOA be canceled? Absolutely. You, as the creator of the DPOA, can cancel it whenever you'd like. You do this by either telling the DPOA agent, or by destroying the DPOA document, or otherwise performing actions that show that you no longer wish to make this one valid anymore. Another important fact is that if you move to another state, the durable power of attorney from your former state may no longer be valid. It's very important to have a local attorney review it. Florida may welcome you with open arms, but its legal system may not extend the same warm welcome to your out-of-state DPOA. How often do people handle, or how do people often handle their durable power of attorney? How do they keep it? Well, there are a couple of options. One, since a DPOA is a live in-force document, some people feel comfortable leaving it at their home, keeping the original there, and letting their chosen agent know how to access it if needed. Some people feel more comfortable having the DPOA with their attorney, with instructions to release it to the agent only as necessary. On the other hand, some custodians of financial assets sometimes don't like to accept durable powers of attorney, or they wish to have them revised. So some people like to register their DPOA with the financial custodian while they're completely healthy. By doing so, they can potentially save the DPOA agent time and aggravation in dealing with the financial custodian and ensure that the person is able to oversee their financial matters quickly and smoothly if it is ever needed. Having an up-to-date durable power of attorney is a very recommended and prudent action to help ensure that your finances are going to be there for you in the best way possible throughout your retirement. Your advisors at Altfest are always willing to speak with you about this very stakey topic or any other planning item to help you take the best care of yourself and your family. I'll pass it over to Andrew.
Thanks, Mike. So I get to talk to you about international investing and why international investments are an overweight in your portfolio today. First, I have a little secret to share with all of you. As contrarian, value-oriented investors, we enjoy talking about international investing more than we do U.S. investing back at the office today. Now, why is that? First, international markets and international investing is less accepted today. It's been a poor performing part of the market for the last 10 years now. But do you know that it's been the best performing part of your portfolio year to date? You might not have known that. So let me provide a brief overview about why we like international investing. First, the international markets are cheaper today. Do you know that investing in Europe and Japan over the last 10 years has produced a return of just 1% per year? That compares to 7% per year investing in the US markets. Now that's quite a difference. And we've done our best at Altfest over the last number of months to try to raise awareness that the US markets are a little bit above their long-term averages. If you look at Europe and developing markets, they are actually at their long-term averages, and in the case of some developing market countries are slightly below their long-term averages. Okay, so the markets are cheaper abroad, but haven't they been cheaper for a while and still produced meager returns? Yes, that's correct. What we see as different now is that there is economic momentum abroad. During the 2008 financial crisis, corporate profits actually grew over 100% in the US. You might not know this, but from 2011 to 2016, profits in Europe and in developing markets actually declined during that period. There was an earnings recession abroad. Now you might ask, well, why is this? Well, first, in the case of Europe, there were a number of governmental missteps in policy. They enacted austerity measures which raised taxes and reduced government spending, which really hurt economic performance. We did the opposite, and that strong corporate profitability, that strong growth in corporate profits in the US that I mentioned, that really came from cost cutting. That didn't come from revenue growth. And they don't have that, in Europe, they don't have the same flexibility with their workforce to drive productivity gains. Now, that was the old dynamic. We're in a new dynamic now in Europe and in developing markets. We actually have corporate profitability growing in those markets. In addition, while our Federal Reserve is slowly withdrawing monetary stimulus, in Europe, as you heard from Dan Fuss, the European Central Bank has its pedal to the metal, and that's expected to last into the future. The unemployment rate in Europe is now down to 9.5% and is heading in a good direction. And there's also a pickup right now in the manufacturing sector, in credit growth. Consumer and business confidence are both at 20-year highs in Europe. It's not just any part of Europe we like. We like specifically the value category, the cyclical companies like banks. Those are historically cheap. So we travel to Europe. Let's go a little bit more off the beaten path to developing markets. In emerging markets, many of whom are commodity exporters, a couple years ago, commodity price declines caused a number of countries, developing market countries, to go into recession. However, commodity prices have now stabilized, and a number of companies within these markets are back to profitability. We added an emerging markets position in 2015, another in 2016, one focused broadly on developing countries, and one more specifically focused on China. And since there's so many different countries within developing markets, we can be very selective here. Brazil, China, and even Russia, and I mentioned Russia, we don't have a back channel communication to the Putin machine. They're all markets we like. India and Mexico are more expensive and are underweighted in your portfolio today. Now, the markets abroad can be very volatile. And headlines abroad sometimes are causing outright market panic. And let me give you an example of that and how this can actually be an advantage of yours. So we, at our firm, have the analytical ability. We now have 12 people working on investments, and we have the flexibility to take advantage of market sell-offs. So 2 weeks ago, when the Brazilian president, Michel Temer, was implicated in a corruption scandal, the Brazilian stock market was down 16% in one day, 16%. That same day, due to that decline, we picked up the leading McDonald's franchise in Latin America, and within a week, that stock had recovered 8%. This year, while the US market is up 8, Europe and Japan are up 14, emerging markets are up 18.5, and even the bonds of emerging market countries are up 6.5%. We also own the bonds in client portfolios. Within emerging markets, I'll give you a couple examples. T. Rowe Price New Asia is up 24%. Brandis Emerging Markets, you'll remember Brandis and Charles Brandis, who was our last year's annual event speaker. His fund is up 14% this year. With cheaper share prices and abroad and economic momentum abroad, we expect returns to continue to be higher outside the U.S. Another way to look at it is that the U.S. is like a Cadillac with 100,000 miles on it, and we think it's time to add a Volvo with 10,000 miles on it to your portfolio and to your fleet, let's say, and enjoy smooth maintenance performance going forward into the future. All right, so that concludes our prepared remarks. We're now going to give everyone the opportunity to ask our panel any questions that you have about any topics that we discussed or anything else that's on your mind. If you just raise your hand, someone with a mic will come over to you, and so everyone in the room can hear your question.
One over here.
Andrew, when you're talking about returns on international market, are you taking the currency fluctuation into account?
Yeah. So you have to be very mindful of currency. And we look at currency, you have some countries in which the currency we think is relatively attractive, and then some markets in which we think the currency is not that attractive. Often when you have markets coming into vogue, you have a lift in share prices and you have a lift in currency. I mean, after all, a lot of these markets benefit from fund flows from U.S. and other investors who are putting money into their markets, and that tends to push up their currency. So often those two things, performance and currency, can be joined at the hip. We also look at the fundamental valuations of currencies. And you have in a number of markets outside the U.S. attractive currencies, and so that could actually add to performance going forward when investing outside the U.S.
We're reading more and more about the importance of renewable energy in this country. Michael Bloomberg has 1,000 mayors joined with him, trying to work on this within their cities. And we also know that some of the governors, led by Jerry Brown, are really, really serious about this. And California has been successful. Are you all looking, at least even though this is not an emerging market, are you looking at ways that we might invest in that too in this country?
Yeah. I think that's a great question. And I'm glad you asked it, because one thing that we have recently designed at our firm, which is, you are all the first to hear about this, we've actually developed as an alternative, or more likely a combination, a sustainable portfolio for clients who are very interested in what's called sustainable investing, socially responsible investing, and certain industries are taken out from that investment requirement, and certain companies are actually added, which is called impact investing, or companies that are perceived as socially responsible, have good governance, are doing things to eliminate things that are bad for the environment. So that's actually something that is very personal to clients. If that's something that's of interest to you, those are investments that can be combined with your existing portfolio, and you all get to be the first to hear about it, because it's something that we've only developed this year, and there are two people at our firm who are analysts on these investments and are just dedicated to looking at these investments.
I don't have a question, just a comment regarding what Ekta had to say. I come in with mixed feelings to the meetings once a year. Sometimes I miss one. This year was important for me to come in. I can't stress how it relieved my stress by speaking with my team, who advised me so well that I was like applauding them, if they were, I would have kissed them. It was that good. So I'm just trying to say, what Ekta was saying is really, really important. They need to know what's going on in your life, and the only way they can is if you come and tell them about it. Mike suggested this DPOA to me. It's incredible. It makes so much sense. It's like logical. We don't know what's going to happen to us. Tomorrow I could be hit by a car, and who's going to pay my bills for the week, or for the month, or forever? So I'm in the process of taking care of that. I would normally just file it somewhere and, forget about it. But he stressed how important it was, and then I picked up on, what every year they send me a note. The form has gotten easier, by the way. It used to be really complicated and long. It's no problem now. So if you're hesitant, go in and see everybody. Attend those meetings.